You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Today's program is a rebroadcast from OIC's webinar program. Every month, we do webinars on a variety of options-related topics. Check out optionseducation.org for more information. Enjoy the show.
Good afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the latest installment of the Options Industry Council's webinar series. My name is Alexander Osinga, and I'm a staff member here at the OIC. I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's webinar, hosted by OIC's Joe Burgoyne, we'll be discussing the most preferable tax treatment given to index and other non-equity options. This is one of two unique tax presentations we will be delivering this week. Be sure to join us tomorrow at the same time to understand the tax implications of covered call writing. And now, ladies and gentlemen, Joe will introduce our topic today, tax advantages to trading index and non-equities options. Joe?
Alex, thanks so much, and thanks to everybody for joining us today. Just a little bit of housekeeping before I turn it over to today's guest, Bob Gordon. I think everybody, who's in the option space knows that the industry puts out a document called Characteristics and Risks of Standardized Options. If you're new to options, do be sure to check with your brokerage firm or the OCC. That document does expand on the benefits and risks of the listed options product. Those of you, again, new possibly to the options space, the OIC, we are the educational cooperative that was founded in 1992. Our mission is to educate investors, financial advisors, and others on the benefits and risks of the listed options product. We are funded largely by the OCC. The OCC is the world's largest equity derivatives clearing organization and the Foundation for Secure Markets. It is the OCC, along with the exchange parent companies, BATS, BOX, CBOE, MIAX, NASDAQ, and the New York Stock Exchange that do fund our educational cooperative. And then the last thing before I bring in Bob, here's a snapshot of volume history going back to 1973 in the industry. And you can see that the industry's had really sustained growth over the last 10, 15 years. We went from the point where we were trading 500 or so million contracts a year. We got electronic access to the market. We got dual listing, where all the exchanges listed options on underlyings. And with that, we got huge industry growth in the early 2000s, to the point where now the industry over the last few years has averaged somewhere between 16 and 17 million contracts a day. We're trading over 4 billion contracts annually. So that's a little bit of housekeeping. Our guest today, really the Options Industry Council, is very, very pleased to welcome today's special guest speaker, Bob Gordon. Bob is president of 21st Securities Corp, which he founded in 1983. Bob has served as an adjunct professor at NYU's Graduate School of Business for over 25 years. He's been involved with the Wharton School's Securities Industry Institute since 1979 in a number of capacities, including serving as chairman for 2 years in the mid-90s. Bob's had many roles in the Securities Industry Association and sits on a number of boards. He's authored Wall Street Secrets for Tax-Efficient Investing, and he's published numerous articles on tax, arbitrage, and hedging strategies. We are glad you have joined us for today's presentation, Tax Advantages to Trading Index and Non-Equity Options. And with that, Bob, I'll turn it over to you.
Thank you, Joe and Alex. And welcome, everybody. So the title here, if you read it, is Index and Other Non-Equity Options. And what we're talking about here is not options on individual equities, but options on indexes and options that trade on an exchange on things that aren't equities. And we'll talk a little bit about what those are, such as a lot of the ETFs and so forth are actually not equities and would fall into that category. And all of these things from a tax standpoint fall into IRS Section 1256. They're called Section 1256 contracts. And where this came from, just to give you a little bit of history to it, was in 1981, the government thought that and everybody was doing straddles. You would do something with futures and commodity contracts where you would have two offsetting legs of a position, and you would take off the loss leg in year one and the gain leg in year two and defer your gains from year to year, and people just kept doing that over and over, and it got to the point where, as the government said, the dentists were doing it as well as the professionals, and they figured they had to end this. So they said, gee, if we don't want people to be able to defer from one year to the next, we can come up with a whole bunch of crazy rules. But maybe the best way to do this is just say that all these futures contracts that trade on the exchange are marked to market at the end of the year. December 31st, you pay your gain or your loss. That's it. And it's the only thing in the whole tax system that isn't a realization-based tax system. It's every year, it's marked to market on December 31st. Now, if you did that every year on December 31st, I guess all the gains would be short-term since you'd never get past a year. So in 1981, Dan Rostenkowski was the head of the House Ways and Means Committee and from Chicago, and didn't think that that was a fair outcome to mark-to-market everybody and making everything short-term, argued that some people invest for long-term and some people invest for short-term, and that if you do want to mark-to-market everything at the end of the year, we should have some kind of a blended rate. You shouldn't just assume everything's short-term. And he actually wound up with a pretty neat deal, I think, and that's that everything is automatically 60% long-term gain and 40% short-term gain, no matter how long you hold it. So the pain was that everything was marked to market at the end of the year, so no one could play these games about deferring and rolling gains from one year to the next. And the trade-off that Rostenkowski got for his constituents and the products that traded in Chicago was that, okay, they're marked to market, but let's assume that everything is 60% long-term and 40% short-term. So what's interesting about it is that's the tax treatment whether you own these things for one day, whether you own them for 2 years, whether you're long the contract or short the contract. And that's very unusual. Usually when you're short, everything's short-term. So no matter how long you hold it, whether you're long, whether you're short, it's the same treatment. And how we got into options land was that this was all about futures, and obviously there's S&P 500 futures, and the government didn't want to have an inconsistency in the way that the S&P futures were taxed and the S&P options. So they said, you know what, index options, just like the things that trade in the futures, index options like the S&P 500 index options, they should be caught the same way and get mark to market at the end of the year and get this 60-40 treatment. So that's how the options got dragged in. Now, it's interesting that Mr. Rostenkowski got this break only for exchange-traded options. Over-the-counter options are not mark to market at the end of the year or not 60-40 treatment. So the exact same option traded on an exchange is taxed differently than the exact same option issued by Bank of America Merrill Lynch. And that's odd because you sort of get to choose how you'd like to be taxed since the taxation of these things are different. So it's only exchange-traded options, and it was only on the S&P 500 indexes. And they said, look, and anything else, it's an option on a non-equity. And what we mean by a non-equity, an equity is a stock. So obviously the options on AT&T stayed the same, but if it was on an index or anything else they hadn't thought of yet, it was going to be taxed as a non-equity option. So index options and all non-equity options get into this 1256 treatment. So if you go through the actual numbers, and these are using the tax code laws that are out there today, including the Obamacare 3.8% tax, if you take 60% of a gain and tax it at 23.8 and 40% and tax it as short-term gains at 43.4, you see you come out with a blended rate of 31.64%, which isn't, quite so horrible. And the government realizes that there are these differences and dichotomies that people can use to their advantage. The first thing you see here is a very long paper issued by the Joint Committee of Taxation, which is basically the lawyers that work for the Congress and put together and write the laws. And you'd see here that they quite clearly admit or point out that based on the type of instrument rather than on the economic characteristics of the instrument is how things are taxed. So you could have an over-the-counter option, a listed option, a structured note, all these different things, ETNs, ETFs, and they're all taxed by the cubbyhole or the instrument that they're wrapped in, not on the underlying investment. So you could have 6 different ways to invest in the S&P 500 that are all taxed differently, even though they all give you the same economic answer pre-tax. They give you a very different answer after tax. The next page is a report from the General Accounting Office, printed around the same time, that talks about everything being taxed in this cubbyhole approach. In the very last line on the slide, you see says it can result in mistakes or opportunities for taxpayers. So obviously there could be mistakes, but what we're trying to do is use this as our advantage. As Alex mentioned in the beginning, I did write a book a while ago, and one of the chapters is choosing your investment tools carefully, because what we do as implementers is we're not smart enough to tell somebody what to do. They tell us what they want to do, and we say, Wall Street's come up with a bunch of different ways to do that. Let's talk about which one's the best for you, given your circumstances. So what we're going to get a little bit further into are index and other non-equity options, and again, exchange-traded options on indices, various ETFs, and MLPs. And remember, these are only on the exchange-traded option. An OTC option does not get this treatment at all. It's only exchange-traded options. So let's look first at the S&P 500. So this is showing you some different pluses and minuses and characteristics of different ways to get exposure to the S&P 500. One's the ETF, one's the open-end fund, one are exchange-traded listed index options, and the next one is OTC index options. So you'll see as you go across that the short-term gains are taxed at 43.4, and long-term gains are taxed at 23.8 for both the ETF, the spider, so to speak, the open-end S&P 500 mutual fund, and the OTC index option. But the exchange-traded index option is taxed at 31.64, no matter whether you're long-term or short-term. So if you were going to make a bet on the S&P 500 that you thought it was going to go up, and you thought you were going to hold it for less than a year, an exchange-traded option on the S&P 500 would be taxed at 31.64. If you bought the SPDR itself, it would be taxed at 43.14. So you could choose how you'd like to be taxed by the instrument that you take off the shelf to invest through. So I think you'll find as we go through this that a lot of these things don't make sense and aren't symmetrical. They just are the way they are. A lot of these rules are rules that the government put in to stop some type of abuse, and although it may have stopped that abuse, it created a different opportunity. There are people in Washington that think this 31.64% is too good a deal, and there's others that think everything in the world should be mark to market. So what we're looking at here is that if you were going to go for a long-term gain, the exchange-traded index option would be taxed worse because it's going to be taxed at 31.64 either way. If you were going to be short the market, shorting is un-American, and it's always taxed as short-term gains. You could buy a put, which is a bearish bet, and then if you were going to buy a put and you were going to be in it for less than a year, you could buy an exchange-traded index option on the S&P 500 index and have that short-term put be taxed at 31.64 versus the short-term gain on a short sale that would have been at 43.4. Now, something that's even odder is that the S&P 500 ETF is an equity. So an exchange-traded option on the SPDR is actually taxed normally, meaning 43.4 for less than a year, 23.8 for more than a year. So if you wanted to buy a bearish bet that could possibly get you a regular long-term gain, what you'd have to do is buy a put on the SPDR. Not a put on the index. A put on the index would be mark to market and 60-40, 60% long-term and 40% short-term. A put on the SPDR would actually be taxed normally. Now, again, this isn't symmetrical. It doesn't make any sense. An exchange-traded option on the S&P 500 index would be taxed differently than a exchange-traded option on the S&P 500 ETF, which is taxed differently than an over-the-counter option on the S&P 500 index. But that's the law. And these things can either kick you in the butt or they can be used to your advantage, and I guess we're trying to work on the use them to your advantage side. The next slide talks about the S&P 500, that, again, short sales are always treated as short-term, and by buying an exchange-traded put, you could probably get a lot better tax treatment, and you would pick which underlying you want, whether it be the SPDR or the index, by how long you're going to hold the thing. The next section is talking about gold. So a lot of people buy the gold ETF. And I think what's interesting here is that the gold ETF is not an equity. And maybe we should talk a little bit about what is and what isn't an equity. So a mutual fund is what's called a regulated investment company. Many ETFs are regulated investment companies. But many ETFs aren't regulated investment companies. As an example, the gold ETF is a grantor trust that owns gold. It's not an equity. It's not a company. It's a grantor trust, which is a flow-through vehicle that owns gold. And the government treats it just like you owned it gold in your hands. So when you have a long-term gain on gold, it's taxed differently than a long-term gain on other things because it's a collectible. And the government gives a tax break to investors who hold long-term because they believe it's productive investment in the economy. And that's why short-term gains are taxed at 43.4 and long-term gains are taxed at 23.8 to give you an incentive to invest in the economy long-term. Well, there's a belief that investing in collectibles, gold, art, etc., isn't adding to the economy. It isn't helping the world's stock of money, and therefore it shouldn't be getting the same benefit. But somehow there was some wisdom out there that says, you know what, collectibles should be taxed at 28%. And then again, you add the Obamacare, Medicare tax of 3.8, and you'll see that a long-term gain on gold or the gold ETF is taxed at 31.8%. So if you buy the gold ETF and you hold it for less than a year, the gain's 43.4. more than a year, 31.8. If you buy an exchange-traded listed option on the ETF, the gold ETF, it's a non-equity option, so it's going to be marked to market and get this 60-40 treatment. And that means it's only going to be taxed at 31.64%. So ironically, the exchange-traded options on the gold ETF will always be taxed better than actually investing in the gold ETF. If you had a short-term gain in the gold ETF, you'd be taxed at 43.4. Here it's 31.64. If you had a long-term gain in the gold because it's a collectible, it'd be 31.8. Here it'd be slightly less, 31.64. Now, the column next to it is an OTC option on gold. Now, remember, OTC options aren't taxed the same as exchange-traded options, so an over-the-counter option on gold could actually get you to a long-term gain tax at 23.8%, but you'd be buying an over-the-counter option from someone who'd have a counterparty risk. Or you'd be buying, UBS has what's called an ETN on gold, and there's the credit risk of UBS, but it's treated like you own a note that's tied to the price of gold. So it's taxed like you owned a note, and that gets you long-term gain after a year as well. So there's all these different ways to be taxed that have their own pluses and minuses. The last I throw on here is that the Canadian gold ETF called Sprott is not the same as the U.S. gold ETF that's a grantor trust. The Canadian gold ETF is what's called a PFIC, a passive foreign investment company, and it could either be the best gold ETF to buy or the worst one. It could be the worst one if you didn't know that when you bought it, you were supposed to make what's called a QEF election. And if you make the QEF election, you could actually get a long-term gain taxed at 23.8. If you didn't know to make that election, then it's always taxed as ordinary income, even if you held it for 10 years. So it could wind up being the worst piece of paper to own. So it's very important that you choose the right tools to plunk down these bets, because on a pre-tax basis, they're all going to give you pretty much the same kind of economics. But on an after-tax basis, there's a big difference between keeping 76% to something or 56% of it. So just to talk about other ETFs, if an ETF is a mutual fund, if it is a regulated investment company, if it is an ETF that does that, then it will be the exchange-traded options will be taxed just like they were an exchange-traded option on AT&T. But let's take the oil ETF. Well, the oil ETF is a commodity pool, which is a partnership that trades oil futures. It's not an equity. It's not a stock. It's not even a bunch of oil sitting in a warehouse somewhere. They're actually just trading futures on oil. And at the end of every month, you get a K1, and it allocates the gains and losses that were taken during the month, and it's very complicated. But it's clearly not an equity. And what that means is that an exchange-traded option on USO, which is the oil ETF, will actually get 60-40 treatment because it's not an equity. So you sort of have to look further underneath the hood, so to speak, of what these ETFs are actually doing, because they may be funds, which is an equity, or they may not be funds. And when they're not funds is when you get into this other taxation. UNG, the natural gas ETF, same thing. It's just a commodity pool trading futures. So an exchange-traded option on that will be a Section 1256 contract. And I'm sure that a lot of people make mistakes and treat them as options like they're options on AT&T. So what you have to do if it's an ETF is look much further into the ETF as to how it actually how it works or doesn't work. The next piece, which I was going into here, was on MLPs. So master limited partnerships are partnerships. They're not equities. And exchange-traded options on MLPs would actually be taxed as Section 1256 contracts, with everything being 60% long-term and 40% short-term. Now, people seem to hate investing in MLPs because of getting the K-1s and all the accounting work that has to be done on that on state tax returns and federal tax returns. So Wall Street's come up with a variety of ways to invest in MLPs, which I've got to tell you are some of the worst inventions that I've seen, because I know that I could just buy an exchange-traded option on an MLP and automatically have everything be taxed 60% long-term. I don't have any K-1s. I don't have any of the accounting hassles. And if you've ever been an MLP and sold it, you'd find that the money that you took in over time that was a return of capital doesn't come back as a capital gain. It comes as ordinary income. So you buy an MLP at 20 and it gives you $8 of distributions that weren't currently taxed. When you sell it, let's say at 20 and you thought you broke even, you don't have an $8 capital gain. You have an $8 of ordinary income. So MLP income is recaptured at the highest rate as ordinary income, and they're a pain in the butt. And I think that exchange-traded options on them would be much simpler, a better tax answer, and save everybody an awful lot of money when it comes to accounting expenses. Now, in MLPs, there are funds that invest in MLPs, but coincidentally, regulated investment companies aren't allowed to have more than 25% in MLPs, or they flunk the mutual fund test. So there are some mutual funds that are actually mutual funds and don't pay a corporate tax, and they only have 24.9% in MLPs, and they still call themselves MLPs, even though 75% of their assets aren't actually MLPs. Or they actually invest in MLPs and flunk the mutual fund test and become tax-paying corporations. So most MLP closed-end funds and ETFs, you basically are paying a corporate level of tax for the privilege of not getting a K-1 and getting a 1099. It's absolutely ridiculous. So there are options on MLPs. There maybe even could be an option on an MLP index. I don't think Illyrian indexes are trading yet. But all those things would be 60-40, and they'd certainly be a better way to invest in the MLPs than the MLPs themselves, and a lot better than some of the inventions that Wall Street has come up with, such as the MLP funds. So this last part, it doesn't necessarily have a screen in front of it, because people say, okay, fine, like what does that actually mean? How do I buy an option on the S&P 500 and not waste a lot of money on what's called time premium? And a lot of people, when you do buy options, you're buying sort of at-the-money options, and you are spending a lot of money for time premium, and if the market doesn't move, you lose that time premium. What I would suggest is what you're trying to do is put on an options position that is equal to owning the index or the spider or the MLP itself. And the way you do that is to create some kind of synthetic short position. I think for a client that was a little bit sophisticated, you could explain to them that if you buy a call and sell a put with the same strike price, that's a synthetic long. For most people, I find that it's much easier for them to understand buying a deep-in-the-money option. So let's say an index was at 100, and you wanted to buy a call option that had a strike price of 70. Well, that call option is worth $30 intrinsically. And it's so deep in the money that there's really no time value. There's really not much optionality to it. And you'd probably only pay about $30 for that call option. And if that stock, index, MLP, or whatever it is goes up, you make money one for one. If the market does go down, the most you could lose is 30%. So I think you could argue that it's actually a safer way to invest. And what the key is to put together an option position that does not have a time premium cost to it. And the simplest way would be with deep-in-the-money options. We are one of the bigger users of something called flex options. A flex option lets you pick your own strike price and pick your own expiration date. And indeed, if something was at 100, you could actually buy a call option with a strike price of 10 for $90 if you wanted to. They're not the standard exchange-traded ones you see on the screen. They're called flex options, but they have the same paperwork as regular options. They have the same guarantor as options. Regular options, they have a CUSIP number like regular options. They're priced every night like by the Options Clearing Corp. They're just like a regular option, except for it's really the listed options exchange's competitive answer to the OTC world, where they can give you what you'd want, such as a very deep-in-the-money option that doesn't have any time premium. and a market maker would be more than happy to manufacture those and take the amount of money they make for doing their skill. So there's the key of all of this is not to waste money in time premium, use options to get the exposure you want, and choose the underlying that will give you the taxation you want. So just to go back, if you were bullish on the market and it was going to be for less than a year, I would use exchange-traded options on the S&P 500 index. If you were saying, no, I want to buy an option that's going to be longer than a year and I'd like to get a long-term gain, taxed at 23.8, you could do that. But you have to buy the option on the SPDR, not the option on the index. And that's if you don't want to go, over the counter at all. And so there's lots of ways to choose how you'd like to be taxed before you start. And if you bought a 13-month put on the SPDR, and after 11 months it was down, you could sell it and take a short-term loss. It's only going to be long-term if you hold it past a year. Anyway, I see that we have a lot of questions, and I think I'm going to throw it over to try to answer some of these questions. One of them I'll answer really quickly is someone asked if we sold a put in November of 2016 and it expired in January of 2017, when is it taxed? Well, all options, whether you buy them or sell them, they're opening transactions. They're not a taxable event. It's only taxable when you close it out. So if you sold a put in November of 2017 and it expired worthless November of 2016 and expired worthless in January of 2017, it's taxable in 2017. Now, whether that's short-term or long-term, you'd have to tell me what the option was on. If you sold a put on a stock, it's short-term. If you sold an option on the SPDR, it's short-term. If you sold an option on the S&P 500 index, it'd be 60% long-term and 40% short-term. So all of the option profits or losses are realized when it's closed, but how it's taxed isn't necessarily just going to be whether it's 12 months or less. It's going to be whether it's a 1256 contract. Anyway, Alex and Joe, let me leave it to you to ask some questions from here.
Yeah, dynamite, Bob. And thanks for a wealth of information there. One of the great things about these presentations, we do have them on demand. So as much as Bob is offering to us all today, we can go back and listen to this in the future, and Alex will have instructions on that towards the end. One of the questions here, Bob, and it's timely, with the new administration in Washington, do you foresee any impact on the 1256 contract treatment?
Well, there's been an awful lot of proposals that were floated before the election. There was a representative camp that was leaving Congress, and because of that, he had the gumption to create a lot of proposals that no one would do if they wanted to get elected again. And one of his proposals was to do away with 1256, thinking it was too generous. There were actually other proposals called the Modernization of Derivatives Act that would mark to market all derivatives. And if you had gains or losses, you would be able to take them as ordinary gains or losses. So that would be a big change. And in some ways, if you lost money and it was an ordinary loss against your salary, that maybe wouldn't be so bad versus a capital loss you couldn't use. On the other side, when you make money, it would only be ordinary income. There's other proposals to market everything. People think the realization-based tax system is too much allowing people to cherry pick and tax loss harvest and hold things until they die and be forgiven the gains tax at death. And there's some proposals just to market everything. I don't know that any of those things are necessarily going to happen, but they've certainly been discussed. And there's one person at the Joint Committee of Taxation who hates Section 1256, and she had her way, it would be gone already. But there is nothing specifically proposed. There's nothing floating around in any of the Trump proposals. But obviously, if tax rates change and the 3.8% Medicare tax comes off, all these numbers have to be rejiggered.
Okay. Well, that'll be an opportunity to have you back if some of this happens. Let's see. As you said, a lot of questions coming in. Here's one. Are options on S&P futures treated the same tax-wise as on indexes?
if there are exchange-traded options. Because again, remember that Mr. Rostenkowski only got this for the exchanges at that time in Chicago, were the ones that were trading all this stuff. So an exchange-traded future on the S&P 500 index would be a Section 1256 contract.
Okay. Another attendee is trying to get clarification on the SPY, the IWM, the DIA, and the Qs, which are ETFs. Do these come under the 1256 tax treatment at 60/40?
If they're actually ETFs that are regulated investment companies like the SPDR is, then they are. But you have to look into each one of those things. I couldn't off the top of my head tell you, if the QQQ is the ETF that owns stocks and is, a stock, a fund, then a option on that would be taxed normally.
Okay,
whereas
so the devil's in the details.
But I think there's both. I think there's options on, the Russell, and there's options on an ETF on the Russell, and they're taxed differently. And I understand it doesn't make any sense. It's just the law.
Okay, and then, because somebody else asks along those same lines, is there a website that lists what instruments, are 1256 contracts? And, I guess...
So our website has an awful lot of information, and one of them, if you went to it, you'd see on the top right-hand corner, one of the tools is, how are your index options taxed? And I believe it lists every one of the index and ETF options and whether they're 1256 or not 1256, trying to keep on top of them, considering how many are invented and die over time is difficult, but we try. But I think anybody, it's not that difficult to see whether the option is on the index or whether it's on an ETF. And then if it's on the index, we know it's a 1256 contract. If it's on the ETF, unfortunately, you got to go further because a gold ETF isn't an equity. The oil ETF isn't an equity. So it's not just whether it's an ETF. It's got to be an ETF that's registered as a fund, not a commodity pool like the oil or gas ETF, and not a grantor trust like the gold ETF.
Okay. Here's something a little different area. The attendee suggests the IRS uses the term substantially identical when considering wash sales, which we haven't talked about yet. Could you please explain any concerns you have if you trade SPX and SPY during the same time period? Does that make any sense from a wash sales standpoint?
Yeah, I think the conservative view. Let's just back up for a second. Forget options for a second. Someone has a loss in the SPDR, and they're going to sell it, and they're going to buy an open-end fund that's also an S&P 500 indexed fund. Those two things certainly aren't substantially identical, right? One's an ETF and trades on an exchange, and one's a mutual regulated investment company mutual fund. They have different managers. They have different fees. But they're both contractually obligated to follow the S&P 500. And although I think there's an argument to be made that they're not substantially identical, I think they're legally obligated to follow the exact same index and strategy. So unfortunately, I think that is a wash sale. And there's other places where the government has decided that things are a wash sale that aren't substantially identical. If I sell a stock and buy any call option, the government tells me that's a wash sale. Even if I buy a way out of the money call option, they tell me it's a wash sale. So the words they use to mean a wash sale are substantially identical, but the rulings they come out with are broader than that. And because of that, I think I would sort of worry about it. On the other hand, I think there's other things called the total market fund that aren't contractually obligated to the S&P 500, and I think you'd be okay. I think there's a second standard, well, a substantially similar standard, and that has if you have a 70% overlap. So maybe you could go from an S&P 500 to an S&P 100 if you measured whether there was a 70% overlap in the two portfolios. But I think to go from an index to another fund, or from index to index, or option to option, if they're all the same underlying security and the exact same strike price and expiration, I think you have a wash sale. But there are a lot of rulings that the wash sale rules don't usually apply to options. If I sold an option and bought the exact same thing back, I think the wash sale rule would apply. But if I got out of an option and got into a new one that was a month later or a different strike price, I think the wash sale rules don't apply. So a much longer answer than I think you wanted.
No,
these
areas
are really
is great.
Not easy.
Right. A lot of subtleties. There's a question here about Section 475 status. Does 60/40 apply to Section 475? Can you speak to that?
We're getting deep into it. The 475 is what a market maker, dealer, trader does to try to make everything ordinary, which would be, if you lost money, ordinary is better than capital, but if you make money, it's all taxes, ordinary income. A 475 entity is allowed to have an investment account that you could have 1256 contracts in, but you'd have to buy it in there and choose how you want to be taxed before you start.
Okay, so as you say, you're getting deep in the weeds with a 475 status.
Yeah, that's really to actually be a trader and be entitled to 475 is a whole other conversation. In that, I think there's a lot of people who just tell individual investors who lost money to, hey, claim you're a trader and it'll be an ordinary loss. There's books about it, Green Trader, etc. And I think those people are out on a limb, and I think it's actually very, very difficult to be a trader. I think a lot of hedge funds that claim to be traders aren't traders. And I think it's going to be the big blow-up in hedge fund tax world over the next few years.
Interesting. Let's see. Here's one. Can you comment on how SPX index option losses are treated? Can you carry over the entire loss to future years, or are you limited to $3,000?
No. If you have a mark-to-market loss, you're allowed to carry it both backwards and forwards, which is very different than any other loss you might have.
Okay.
So let's say that you owned an option on the S&P 500 index, and at the end of 1 year it was up, so they marked to market and you had to pay a gains tax. And then by the end of the next year it was down, and then you have a loss. And then maybe you don't have any gains to use it against. So because you're marked to market, another benefit of 1256 is that a 1256 gain or loss can be carried backwards or forwards when a regular gain or loss couldn't. And again, they're trying to make up for the fact that they're forcing you to get marked to market at the end of the year.
Okay, well, we have somebody wondering, do you have any plans to write another book on tax-efficient investing in the future?
It was more work than I ever would have thought.
Okay. All right, very good. So, well, I think that's probably it in terms of questions that we'll cover today. Any closing comments, Bob, before I turn it over to Alex, and then we're lucky enough to have you back tomorrow.
Right, and tomorrow it is not necessarily just the taxation of covered call writing, but some of the traps and some of the opportunities that are there in managing a covered call portfolio.
Well, we'll look forward to that. And with that, Alex, I'll turn it back to you.
Awesome. Thank you. Great job, guys. Ladies and gentlemen, thank you for your time today. While we weren't able to get to all of your questions, we have our investor services desk ready to help. Feel free to reach out to them at options@theocc.com. That's options with an S @theocc.com. Again, today's session will be archived and will be accessible in a few hours using the same link you used to join us today. Additionally, our webinars are available on the OIC YouTube channel, so you can review a number of option strategies and concepts at your own pace. Many of you asked about further education. Please visit optionseducation.org, the OIC's website, and see the Getting Started section for further reading. And be sure to follow us on social media, like us on Facebook, follow us on Twitter to stay current with OIC's offerings. Thank you again for attending, and hope to see you tomorrow at the same time.
Investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of the Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.